So agenda is that first I'm going to talk about the concept of market capitalization or the market cap and how do we classify large, mid, and small cap. Then I'm going to show you using the NSE website, what is the stock index, why the index. You would have heard terms like Nifty is a free float market capitalization based index. What is that? What are some of the other index that you track? So all about that. I'm also going to talk about what are exchange traded funds, ETFs, and mutual funds and different types of mutual fund, and how do you trade in mutual fund, not trade, but invest in mutual fund in Zerodha coin. So that is the first part. The second part is more something which we will be using for our trading in the future sessions. So the basic is how do you set up a chart? What is a technical chart? What are some of the things that I look and how do I set up a technical chart in Zerodha? I'm also going to show trading view. So far we have talked about buying something and then selling it. How do you first sell something? If you anticipate the market is going down, how do you first sell something and then you can buy? I'm also going to show you that when you are taking a position, you're buying something or selling something, how do you know that what is the cost implication? What is your break-even point? How do you look at the brokerage calculator? And then I will also give you an example of certain tools that are typically used. I use for the option trading one of the tools called OI Pulse, or there are a few others like Opstra and Sensible. So what are those tools? The other thing is, you may have certain things you want to shortlist a set of stocks based on certain criteria. For example, if you want to know that which are the stocks which are trading near their lifetime high or 5% below their in that range, all-time high, how do you do that? So that is where scanner comes into the play, right? So that is the agenda for the day. Yeah. So let me start with the market capitalization. So simple. When you set up any company or anyone sets up a company, there are certain number of shares which are issued. And then there is a equity capital that they bring. So just to take an example, a person starts a company with 1 crore equity capital and there are 1 crore shares. So if you look at the scenario where the equity was 1 crore and the number of shares is 1 crore, 1 rupee per share, the value becomes 1 rupee. So that at the initial, when the company was getting set up, and that 1 rupee is called the face value. So typically in India, the face value used to be 10 rupees, but now you have face values with 2 rupees, 5 rupees, 1 rupee. Okay. So that is when you start the business. Okay. Now, as you start doing the business, every year you earn certain profit, hopefully, and part of you take out by way of your dividends to the promoters, and part of it you put it back in the company. Now that gets added as a reserve and surplus, and the company's value keeps on increasing. So for example, you set up the company with 1 crore capital. First year, you made a profit of 50 lakh rupees. 20 lakh you took out as a profit. 30 lakh you put it back in the company. So now the 1 crore has become 1 crore 30 lakhs. Next year, if it becomes 1 crore, another 40 lakhs, you do the same way, the way you did 30 lakhs, then it becomes 1 crore 70 lakhs. Now, what is the value of each of the share? When you look from that perspective, we started with one share having a face value of 1 rupee. Now, the company has become 1.7 crores instead of 1 crore. So the face value of the share has become from 1 to 1.7. That is called the book value. So the face value stays as 1 rupee. Face value never changes, but the book value has become 1.7. Okay. Assume this company goes to another investor, and that investor wants to invest in this company now. You have put in 2 years of effort as a promoter. The company started with 1 crore. Now the company has 1.7 crores. Will you sell your share at 1.7? Probably not, right? Because you have already done thing. There is a future potential that company will keep on making profit. So when you are selling your share, assume that someone else wants to buy part of it. Most likely you are going to get more than 1.7, could be 2, 2.5. So that is the market price. That is the price someone is going to take, going to pay you. Okay. Now, I will not get into the complete detail. There's something called discounted cash flow method, using which you compute the fair price. That becomes complicated. But broadly, you see that if the company is doing well, if the company is growing, for example, company is growing at 40% per year. Now, what do we get in FD? 5%. So you are investing in a company which is growing at 40%. You don't mind to buy the company at little higher price, even if your gain will not be 40%, but say 25%. Okay. So just to take an example, let's say the company is at 100 rupees. Next year, it will become 140. If you buy it at 100 rupees, your profit is going to be 40%. Right. But you are okay to gain, say, 30% instead of 40%. But you know that today company is at 100. Next year, the company's value will be 140. And your return expectation is 30%. So what price you will be willing to pay for that? 140 divided by 1.3, right? Because you want 30% return. So 140 divided by 1.3, whatever is that money, so which will be higher than 100. Even if you pay that much, let's say you pay 105, you will still get 140. So your return will be 35 divided by 105. So don't get into all the computation. But what you should understand, and whenever I talk about little complicated, if you're not getting it, I mean, I know it's many of you are getting it, but in case you're not, ignore it, because some of those complicated things are not required for trading. And once you start doing it, you will get it. So keep that in mind. So the three things. Yeah.
Yeah. When we say growth, how do you define growth? Is it in terms of the revenue or the profit, or now in the new age companies, it is more about acquisition of the users? How does the market define the growth?
Yeah. So a very good question. But when it comes to actual financial metrics, it is the profit, right?
Okay.
The example that I'm giving, the book value will change only if there is a profit. Otherwise, if there is a loss, then the book value will get eroded. Okay. The point that you are making is that how does market value a company? Right? Yeah. So to value a company is not only about growth. It's multiple parameters that you talked about. For example, can it grow in future? How's the overall segment growing? For example, a company is growing at 30%, but is playing in an industry which is growing at 5%.
Okay.
Then depending on what market share they have, very soon they will reach a saturation, isn't it?
Correct. Yeah.
Right. They cannot keep on growing at 30% because after a point, the industry itself is growing at 5%. So your question is more connected with the valuation. How do I value a company? And assume the example that I gave you, that this year you wanted 40% growth. You may say, I'm willing to sacrifice growth for the next 2 years. Even if I don't get any return for the next 2 years, I'm okay. Okay. Because beyond that is going to, like the new age technology. The only thing is, let's say if a lot of people think that way, then they will give a much higher valuation for the company. So your stock market will also your stock price will also grow. So keep in mind, the stock market price is decided not on the past performance. Mainly, past performance is taken into consideration, but the price is decided on the future expectation of the performance.
Got it. Yeah.
And how do you expect future is science and an art.
Right.
Okay. So coming back to what I was talking. So face value of this example that I was giving was 1 rupee. Book value was 1.4. But the market price which someone was willing to pay for it was higher than 1.4, because next year that 1.4 will become 2. So someone was willing to pay, let's say, 1.6. So that becomes the market price. Now, if the market why I'm talking about the market price, because when the concept of market capitalization comes, market capitalization is nothing but the number of shares of the company multiplied by the current market price. As simple as that. So the market price is 1.6, number of shares is 1 crore, then the market cap of that company is 1.6 crores. Is that clear? So market cap is nothing but number of shares of a company multiplied by the current market price. Okay. Now, why is it important? It is important from your portfolio diversification perspective. You want to invest in the companies which are stable, which are large. And most of the time, if it is a large company, it's a known company, risk is less. So if you're investing in an HDFC Bank or an Infosys or a Reliance, you are taking relatively lesser risk than say you are investing in Nika. Because Nika, people don't even know what will happen. I mean, of course, there is expectation built in, etc. Or let's say Kajaria Ceramics or any of those other companies. Typically, it's not necessary. I mean, sometimes the large companies also fail. So a lot of the investment strategies take into consideration the market capitalization of the company and how their portfolio has different stocks from different market cap. So in India, the way we define is this. We classify all the stocks that are listed into 3 market cap categories: large cap, mid cap, and small cap. And as I was mentioning, there are about 2,000 companies which are listed in National Stock Exchange, and there are about 5,000 companies which are listed in Bombay Stock Exchange. So the definition of large cap company in India is a company having a market capitalization of more than 20,000 crores. Okay, so the company which is greater than 20,000 crore is large cap. Mid cap is between 5,000 crore and 20,000 crores. And small cap is anything less than 5,000 crores. I strongly recommend to use NSE India website. Okay, so this is the NSE India website. This is wealth of information. I mean, of course, once you start graduating to more proficiency, you may subscribe to some of the professional products. But to begin with, this is free. And this is wealth of information, both for the live market as well as a lot of data around our markets. So nseindia.com is the website. You can see, I'll share the link on WhatsApp as well. Now, this has a lot of segments. It talks about various data. Ultimately, the data gets generated in the stock exchange, and the stock exchange shares that data, which is used by traders to take different decisions, all the market participants. Now, if you look at it, there is something called index here. Let's see what is index. Now, on the National Stock Exchange, these are the index which are getting traded. And this is the position as on November 18, 333, when the market closed yesterday. So at the close of the market, you see these are the most popular index on NSE's Nifty 50. So that is the top 50 stocks in NSE. The next one is next 50. That is 51 to 100. Then Nifty 100. So you can read this. I don't have to read all of them. And then there are 13, I think, or 11 sectoral indexes, right? Indices. So Nifty Bank, Nifty Auto, FinService. So why this index? What is this index, if you are wondering? Now I'm talking about Nifty 50, Nifty Bank, Nifty Auto, etc., etc. These are the ways for done for 2 reasons mainly. One is if you want to get an overall pulse of the market. As I mentioned, there are 2,000 stocks trading in NSE or 5,000 stocks trading in BSE. Is the market going up or down? How do you know? Are you going to look at all the 5,000 stocks or 2,000 stocks and compute the price? The answer is no. Because there are companies who matter and there are companies who don't matter, and both are not same. Just to take an example, Kajaria Ceramics is not having the same importance in the Indian market as Reliance. They're 2 different extremes. So what is happening to Reliance matters more than what is happening to Kajaria Ceramics. But let's say someone is invested in small cap. They want to understand what is happening in the small cap. So they need an index which reflects the small cap. So essentially the index was created as a mechanism to convey to the investors that what is the market pulse, what is happening in the market, and have an understanding that is the market going up, going down, which direction things are moving, what are the activities that are happening. That is one of the reasons. The second reason why these indices are created is with a view to benchmark your performance. So let's say that I have a fund and I say that it's a large cap fund. How do you say that whether my fund has performed better than the market or not? What is the market? You can't just take example of one of the stock and start comparing the fund performance. That won't be fair. So they benchmark against these indices. So if it is a large cap fund, they may most likely benchmark against Nifty 500 or Nifty 50. So when you read about a fund, you see which index they are benchmarking their performance against. That is true for the PMS as well. It's true for the AIF also. So when you are investing, you say, what is your benchmark? And the question you should be asking that, because then you know that your portfolio is invested in which segment. So the company is benchmarking against Nifty 50. You know that these are real mega cap stocks, which this index is going to invest and track the performance against. Okay. So the way it gets computed is based on the weighted average of the market capitalization. Just give me 1 second. Just give me 1 second. So it's simple. Nifty 50 is the top 50 stock. What they do is they assign the weightage based on free float market capitalization. Okay. Now, what is the free float market capitalization, if you may ask? I talked about the concept of market capitalization, right? Free float market capitalization is nothing but the active shares which are available for buying and selling, which means they take out the shares that belong to the promoters, because typically a promoter will not keep on buying or selling the stock frequently. So just to take an example, Wipro is a classic example. Wipro has a much large market cap, but the Wipro weightage in Nifty 50 is not that high, simply because a large part, I think it is close to 75 or 80%, is held by Mr. Ajim Premji and family or the trust, and it is not available in the market for trading. Okay. If you have any question, you can ask me. Okay. But essentially, for determining the Nifty weightage of a stock, the free float market capitalization of the company is taken into account rather than total market capitalization. And that's pretty much true for all the indices in the world. Okay. Most of the common things like S&P 500 in US or Dow Jones Industrial Index, all they take is the free float market capitalization. I hope that's clear. So in India, you would hear Sensex, and I'm sure that you would be, talking about Sensex is 60,000, 61,000, etc. These days, you start seeing people talking more on the Nifty. And one of the way I determine if this is an experienced trader or it is a novice or not so active, I would say, not experienced novice, but active or inactive trader, is the way they say, market has gone up, we are at 62,000. So if someone says market has gone up, we are at 62,000, I know that the person is not very active in the market. But if the person says that, market is going up and Nifty is at 18,200, then I know that is a relatively more active trader, for the simple reason that while both Sensex and Nifty are large indices in Indian market, Nifty is traded in the market, Sensex is not. So someone who is doing futures and options trading, or someone who is even buying an ETF, would be trading in Nifty but not in Sensex, and that is why I made that comment. Okay, so coming back, you can clearly see that Nifty is closed at, this is the closing price because that was close of the day, closed at 18,307, and yesterday it went down by -0.2%, right? And this is the open price. high price, low price. Okay. So this is the close price because that's the current. So 18307 is the close or the price at the time this chart was created or the table was created. Nifty opened at 18382. So as you can clearly see, after opening at 382, it came down and closed at 307. So yesterday after opening, Nifty went down. After opening at 82, it made a high of 394 and a low of 209. So what was the range? If someone says what was the range of Nifty yesterday, the range was high minus low. Nifty moved between 18394 to 18209. That was the range. So I was talking about market changing. Earlier, Nifty movement used to be in 50, 60, 70 points range. These days, it is very, very common. Nifty moves 200, 300 points in the same day. Okay. So this is the high and the low, and I will show you the chart. There also, it will become kind of important. I think, Santosh, you had a question on Sensex. No, Sensex is, and the question was that, is Sensex the floating market cap of all 2000 company stocks? The answer is no. Sensex is 30 stocks on Bombay Stock Exchange, the top 30 stocks. Like Nifty is the 50 stocks in NSE, Sensex is the top 30 stocks in the Bombay Stock Exchange. Okay. Yeah. So for someone who is interested in trading, particularly understanding the current price, the open, high, low is important to determine various things. And how do we do that? We will do it in the subsequent sessions. Now, if you want to see here, what is this product? What is it made of? You can go to the products, you can click on indices, and you have things here, which is about indices. As you can see, you have the broad market indices, sectoral indices, thematic indices. So Nifty has, NSE rather, National Stock Exchange has created multiple indices so that the benchmarking can be done and also the market participants can make sense out of the market movement. So if you just click on Nifty 50 index, you have all the details. You can download Nifty 50 brochure and you can see the white paper. I mean, this is for really if you are interested. And as you can see, Nifty 50 represents almost 67% of the total market capitalization of NSE. What does it mean? Means that while there are 2000 companies listed on National Stock Exchange, just the top 50 companies constitute 67% of the market. Okay. And in those companies, which constitute 67% of the market, if you look at the total trading volume, it is approximately 53% of the total trading volume of Nifty comes from these top 50 companies. Okay. So that's about some of the key attributes. And then you can see that how in that 50, financial services has a major say. 38.85% is financial services. Now, why am I talking about all these things? The reason I'm talking about all these things is that let's say that you do certain analysis and you figure out that the financial segment or the banks are under stress in the economy, or the non-banking financial companies are under stress in the economy, then it is very difficult for overall market to go up, because in the Nifty top 50, 38.85% is making up. Whereas, if you look at telecom, it is 1.51%. So there are just Bharti Airtel and part of Reliance. Now, if that is the case, then even if telecom, I mean, of course, there are other fallouts. Telecom doing well or not well can have impact on banking. But in general, if one company, or let's say Bharti Airtel, is not doing that great, doesn't mean that market will fall. But if some of your large banks like HDFC Bank, ICICI Bank, SBI are not doing well, market will struggle. So that's an important point, right? Then, so this is all the stats, right? I mean, pretty much I advise you to go and read this paper. Okay, so I think I have covered that, the indices. And and as I told you, I mean, all of us know the concept of weighted average. So the way the Nifty value is computed is based on the weighted average of these 50 companies. Now, one of the things you please keep in mind that what are the top 50 companies today were not same as what it was, say, even 6 months back. 6 months back, Shree Cements was part of the index. Adani Enterprise was not. Today, Adani Enterprise is part of Nifty 50. Shree Cement is not. So every 6 months, NSE does a review and determines that which company should be part of that. So in a way, if you have, or I will talk about the concept of momentum investing. If you look at it, Nifty itself is in a way a momentum portfolio where the stocks which do well get in and the stocks which are lagging get out. So Yes Bank used to be part of Nifty at some point in time. Today it is not. Many companies, when Nifty 50 index started, are no longer part of Nifty 50. So today, for example, just recently, LTI and Mindtree merger has happened and they have become large market cap. So most likely, if not in this review, the next review, LTI Mindtree may get into Nifty and something may come out. Now, why am I saying that? The reason you should be knowing that, even if you are, let's say, not trading in that particular stock, the reason I'm saying that there are a lot of funds, large funds, who have a mandate to track Nifty or invest certain percentage of their fund in Nifty stocks. Thereby, whenever a stock comes in Nifty 50, certain amount of money needs to move in that particular stock because that is how many funds are designed. So there will be more activity. The company coming out of Nifty, they will see some money getting out of them. So the price may fall more. So knowing what is there in Nifty 50 and what are the changes that are anticipated, in a way, can help you to determine some of the stocks where you could invest. Okay. It has the other implication as well. For example, Adani Enterprise has now become part of Nifty. Any of you who have been looking at this Adani Enterprise, the share price has been running like crazy. Now, once a stock becomes part of Nifty, then there are a lot more due diligence, a lot more big funds who are in that stock. And if one stock runs, then that has an implication on the overall market. Thereby, the chances of that, it can go up every day with that kind of volatility, that in some sense reduces. Only thing is that the free float of Adani Enterprise is not very high, so the impact is not so high. If the free float would have been something like what Reliance has, the impact or the impact on Nifty as well as the impact on Adani Enterprise stock price would have been much higher. Okay. So that's all about indices. I hope it is giving you an idea, and start looking at NSE website, start looking at Nifty levels. And if you know Nifty is going up, down, where it is, what is the range, it will give you a sense of where the market is. Also, you should look at other sectoral indices. So there is always this concept of sector churn. Now, for example, last year, Nifty IT was the flavor. A lot of money was getting into IT, and the way the valuations were in IT were skyrocketing. Now you see IT is down and money is moving to, again, banks, financials. Now, if you understand this sectoral allocation and the rotation, and if you can spot that as they are happening or early in the cycle, you can make a lot of money. So you start looking at the sectoral indices, which I said, like Nifty Auto, Nifty IT, Nifty Financial Services, and see what activities are happening, how are those indices performing. And if you can spot when they will turn around, you can make lots of money by investing in the winners of that particular sector. Okay. Final point on that before I move to the mutual fund and the ETF is there are three. So indices are not only just to look, but in many markets, there is a trading that happens in these indices. So people, instead of taking bet on one company, you can anticipate what will happen to the overall index level action and you can trade in that particular index. So in India, there are 3 indices that get traded actively in the market, and that trading happens only in the futures and options. You cannot buy straight away a Nifty in cash market. So the way you can buy Reliance, you cannot buy Nifty, but in the futures market, you can buy Nifty futures. So the 3 indices which get traded in India are Nifty, Bank Nifty, and Fin Nifty. Fin Nifty is a new entrant to this trading, which started just, I think, less than a year back. Bank Nifty is the favorite of traders, particularly the option traders, because the movement in Bank Nifty is very fast. So people who typically buy options as opposed to sell option, they play in Bank Nifty quite frequently. I will also talk about the concept of expiry, because these are the contracts. The expiry in the National Stock Exchange for Nifty and Bank Nifty happens every Thursday. You would have seen my message on WhatsApp. But the expiry on Fin Nifty happens every Tuesday. Okay, so these are the 3 indices. Fin Nifty is still catching up. It still doesn't have the kind of liquidity which Nifty or Bank Nifty has, but slowly it is catching up. So hopefully the trading in Fin Nifty will also accelerate. Okay. Great. Now let me talk about mutual fund, and I'm not going to describe what is a mutual fund. I think all of you know it. Okay. What is important to understand in the mutual fund is that there are 3 categories of mutual fund. The first one is the equity-based mutual fund, which invests in different stocks. The second one is debt mutual fund. So debt mutual fund, and I'll describe a little bit more. And the third category is hybrid, which is a mix of equity and debt. So these are the 3 broad categories. Now, if you look at the equity mutual fund, the first category, the typical classification, one is based on the market cap of the stocks they invest in. So you will hear the terms like large cap mutual fund, mid cap mutual fund, small cap mutual fund, right? So these are the 3 broad categories. And now SEBI has regulation. Earlier, you could have classified yourself as a large cap mutual fund. And even if you're buying mid cap, there was not so much of attention which SEBI used to pay. But now there are strict, rules which are applied. Okay. So that's one classification. The second way, if you don't want to be just large cap or small cap or mid cap, then you can say that I'm flexi cap. And one of the very popular flexi cap strategy which is there is PPFAS mutual fund, which has done pretty well. But there are many others from Kotak, from Axis. Pretty much all the large fund houses have flexi cap. In the flexi cap, the rule is that they need to have 65% of the allocation in equity, and that's it. They can decide whether that's 65% or even 100%. They can go up to 100%, of course, is in what proportion in large cap, mid cap, and small cap. So there is no restriction on that, as long as 65% of the allocation is in equity. So that is a flexi cap. And then you have something called multi-cap. So there is a subtle difference between the multi-cap and the flexi cap. In multi-cap, you have to necessarily invest minimum 25% in large cap, 25% in mid cap, and 25% in small cap. That is the minimum. So 75 goes there. Remaining 25%, the fund manager can decide where they want to invest. But 75% strictly has to be in 1/3, 1/3, 1/3. So again, there are some popular multi-cap strategies. One of the things which I like is quantum active fund, but it keeps on changing, right? So that is one category. You would have also heard about ELSS, which is equity linked savings scheme, which many of you may be using for your tax saving purpose. So these are nothing but there is a lock-in, and you get some tax benefits if you invest in this stock. These mutual funds, and that is why these are the equity linked savings scheme done with a view to encourage people to participate in the equity market. Yep. So those are pretty much mutual fund. Mutual fund taxation is in your hand. And if it is an equity mutual fund, it is taxed as per the capital gains rule, short term, long term, etc. Now, the second category of mutual fund are the debt mutual funds. Now, in debt also, there are different types of funds. So these debt, when we say the debt, they essentially invest in government bonds or the debentures or the instruments done by the private company. So let's say a private company wants to raise loans. They want to take loans. How do they take loan? They can go to a bank and take loan. That is one way. But they can also issue FD, for example. They can issue debentures. So these are different instruments. What these funds do is they subscribe to those debt instruments. So if, let's say, Tata Motors is coming out with an FD giving 8% return, whereas the bank FD gives 5%, this fund can potentially invest in that Tata Motors FD. Okay. But each of these funds clearly say that what kind of instruments they will invest in and are the maturity of these instruments short-term or long-term. I think we understand the concept of maturity. For example, when we invest in a fixed deposit, the bank asks, right, are you opening this fixed deposit for 1 month or 6 months or 1 year or 3 years? Now that is the tenure, right? So when your FD will mature, it can mature after 1 month, it can mature after 1 year, it can mature after 3 years, or whatever be the duration. Now, these debt funds, debt mutual funds, by design, some of them invest only in ultra short-term maturity instrument. There are overnight markets, and that's more complicated, so I don't want to get in there. But you may have heard about SLR and CRR requirements of the bank. So there is interbank lending. Banks need to lend to each other just for the overnight, meeting the requirement. And next day they will settle it. So many of these funds invest in those kind of instruments where they lend to a bank, which then does the interbank, or these are ultra short-term debt instruments, which will mature anywhere between say 1 day to 3 months. And those are typically called the liquid fund because they're highly liquid and they mature pretty fast. Then there are funds who invest in long-term debt instruments, which will mature, say, 10 years down the line or 5 years down the line. So you need to understand when you are investing. Sometimes what I've seen is that while understanding of the equity mutual fund is, I think, at a reasonable level, the understanding of the debt mutual fund is still very, very shallow. It will be good if you are investing. Keep two things in mind. One thing you should understand, how does the interest rate impact the return of the debt mutual fund? So many times, erroneously, we think that equity mutual fund is the only thing which will go up and down. And the debt mutual fund is not, because we equate it with fixed deposits. Is that correct? I mean, you just think that debt mutual fund is safer because it's not like equity which will go up and down. That's not true. Particularly the long tenure debt funds have a huge impact of the change of interest rate in the economy. Okay, and for that you need to understand the concept of yield and the coupon rate. And I think that will become too much, but keep in mind that when you are investing in a debt mutual fund, don't blindly assume that you will not lose money or you cannot lose money. So you need to do your due diligence, because if the debt fund you are investing in is investing in long-term debt instruments, and at the point which you are buying it, the interest rates are lower. If the interest rate goes up when you have bought, after you have bought, your money will reduce. The price of that, the NAV will reduce. Okay, so only fund which is kind of immune to all this is the liquid fund or the money market fund. Money market example I talked about, where there is an interbank lending, etc. And there the interest, or sorry, the return that you get is very close to the return that you anticipate in a FD. For the simple reason that they invest only in 1 day to 3 month maturity instrument, So even if there is an interest rate change, they don't get impacted much because the next day they start investing in the interest rate, the instruments where the interest rate is higher. Keep that in mind. So liquid fund is one category, which is pretty safe. Is like pretty much like an FD, but the rest of the debt funds carry their own risk. Okay. So now that brings me to another instrument called ETF, which is exchange traded fund. So while we talked about you cannot buy Nifty just like that, the only way you can buy Nifty is through Nifty futures in the FNO market. Now, if you don't trade in FNO, you don't have that segment activated, or for whatever reason, don't want to take that kind of risk, how do you take a position in Nifty? Because all you're saying is that, look, Nifty is 66% of market cap of NSE, which means almost 66% of the market cap of entire organized sector in India, which is huge. Now, if you believe in the Indian story, if you believe that the India is going to do well and our economy is going to do well, instead of trying to do stock picking, instead of trying to say that I'll buy this Deepak fertilizers or Deepak nitrite or certain chemical stock or certain sugar stock, instead of that, if I'm confident about Indian economy growing, why don't I just invest in Nifty 50? Right? And Nifty 50 typically will give you the return which is in line with the GDP growth plus inflation. So if Indian GDP is growing at 6%, inflation is say 7%, then over a period of time, 1 year could be an aberration or 2 years could be an aberration. But over, let's say, even if you take a 5-year horizon, Nifty return will be in line with the return of GDP plus inflation. And that's a huge thing because FD many times doesn't even cover your inflation. Forget about covering the GDP growth. So Nifty definitely is an instrument which can provide you that return. Now, how do you invest in Nifty? Because Nifty is a notional thing. It's a weighted average. It's a virtual entity, right? There is no company called Nifty. So how do you invest in Nifty? The answer is you cannot directly, right? Because it's not a real company. How do you invest in something which is just on paper? So the only way to invest is through a fund, which in turn copies the weightage of Nifty and will invest in each of those 50 companies in the same proportion. I hope you're getting my point. So let's say that I create a fund which is 100 crores. And what I do is that if Reliance has a 9% weightage in Nifty, 9 crore I invest in Reliance. HDFC Bank has 8% weightage, 8 crore I invest in HDFC Bank. So every time that weightage is changing because of the market, because of changes in Nifty, I adjust my weightage. Right? If I am doing that, what I can do is I can keep you away from that, you as an individual investor, and you are investing in my fund. My fund is ensuring that I'm investing in all the 50 companies in the same proportion all the time. Okay, that's what I do. For example, if Reliance goes up 3%, and that 100 crore, rest of them for a moment, assume they didn't go up. So Reliance weightage will go up. So immediately I will sell some Reliance share and I will buy other 49 shares to ensure that I'm tracking Nifty weightage. All that work I can do as part of the fund, which you as an individual investor may find it very, very difficult to do. So if I'm doing that and I'm creating the fund, you can invest in the whatever is the unit value of the fund. So if it is a mutual fund, that would be NAV. And that is an index fund. So the two ways you invest other than the futures market in Nifty is through an index mutual fund. So there are Nifty 50 index mutual fund who track Nifty. And so when you are buying that one unit of that particular fund, that money is getting allocated to all the 50 shares in the proportion of their weight in Nifty. The other way the challenge in the mutual fund is that you can place order during the day, and that order gets executed only at the NAV at the end of that day. So assume for a moment, you assume that market today is, falling. And there's some big news. Now you spotted that trend early. 10 o'clock in the morning, you spotted that market looks to be very jittery. It may fall another 300 points. I want to lock in my profits right now. If you have invested in the mutual fund, you cannot do that. You can place the order, but the order will get executed only at the closing price of that particular day. And by then, your markets may have fallen even another 3-4%. And then the second thing is, the entire thing about investing, you get the money after 2-3 days, etc., etc. So that is the mutual fund. To overcome that, they've created an instrument called exchange traded fund, which for all practical purpose pretty much works in the same way as an index fund. And typically these ETFs track a particular index. That could be a sectoral index, or it could be a Nifty, Bank Nifty, etc. So they do the same thing. But now instead of creating a mutual fund, they created this instrument called ETF, which is exchange traded fund, which you can buy or sell like any other stock on NSE. So that Nifty is traded as Nifty Bees, that is managed by Nippon India Mutual Fund. That's one of the most famous Nifty 50 index in India, called Nifty Bees, Nifty BEES. You can search on that symbol for Nifty Bees, and you can do the trading there. Okay. So ETF is something where you can buy or sell anytime. There are buyers and there are sellers, and sometimes there are more buyers, so the price may go up temporarily, but the fund ensures that they release more units in the market to manage the price. Okay, and the value today of Nifty Bees is roughly 1/100th of Nifty value. So because of the ease of trading, otherwise Nifty is trading at 18,300. So even if you want to buy 1 unit of Nifty, you needed 18,300. But to make it easier, what they have done is broken it down into 1/100. And the Nifty Bees would be trading closer to 183 rupees. So even if you want to invest, let's say 1,830 rupees, you can buy 10 units of Nifty Bees. Is that clear? Any questions so far? Okay, I hope, this is
Dheeraj, I had one question.
Some of it is very basic. Yeah, go ahead, Sagar.
Yeah, I was just wondering if, between different Nifty funds itself, is there that much of a difference? Or, are there, or would it matter? I'm assuming there'll be small changes anyway, but would it really matter?
Not really. There are some minor changes. One of them is expense ratio.
Okay.
And the second one is tracking error. These are the two things, right?
Okay.
So the expense ratio is obviously, since they are doing nothing, is a very passive strategy. All they need to do is, some computer program which is mimicking Nifty and investing there. So why should you pay higher expense to any fund? Okay.
Right.
So look at the expense ratio. Lower the better. But the second thing is this tracking error. So, if you have a very fast computer program or whatever way you have programmed, your tracking error will be much lower. And how fast you can take the trade and come to the position. So if Reliance is going up in the example that I was giving 2%, how quickly can you sell Reliance and distribute to the other constituents? And if there is a lag in that, then you would not be for that much of time. You may not be exactly in sync with Nifty. So that is called the tracking error. That's it. Otherwise, there is pretty much no difference.
Got it. Thanks, Dheeraj.
Okay.
Dheeraj, there are something called dynamic bond funds.
Correct.
So do they adjust and then dynamically and based on the interest rate? Is it good or risky?
Yeah, they try to make the adjustment. So depending on two things. So some of them have both the bond and the equity as their investment, and they do the reallocation based on where they're making more profit, where things are going down. So they change that. The second one is within different instrument itself, they keep on churning that. So yeah, I mean, I think they're good. It depends on the real strategy. What is the strategy behind it? Because sometimes over trading is not so good, right? You incur certain expenses or you may take wrong decision also. But in general, dynamic should perform better than static.
Okay, because the interest rate fluctuations which you mentioned, and based on that, do they adjust in
Yes.
terms of long term versus short?
They have, but you need to read, and that is why I'm saying it is important for us to understand, because you will have to read the fine prints of that particular fund.
Okay.
And then only you will realize what is the strategy, what are they doing. And that is the point I was making at the beginning of today's session, that even if you are not doing it yourself, if you understand these concepts, you can potentially evaluate that decision better.
Okay.
Right? Because you are very right. If let's say interest rate is going up, shouldn't they churn from long tenured bonds to short duration instruments?
Yeah.
Makes sense, right? And they do it, but some of them have a different philosophy, right? They may say, I'm looking end to end. I have a lock-in.
Yeah.
So for me, what matters is the coupon rate. Right? So he says it doesn't matter because I'm not trading there. Your coupon rate is 8%. I've invested in 8%, 9%, and that is what I'll give if you hold it till maturity.
Yeah.
So it depends on the philosophy. Yeah. Okay. Great. So I think I've covered. So ETF, you got it, right? I mean, ETF is kind of a mutual fund, but something which you can instantaneously buy and sell in the live market and acts as a share. So it has a combination of a mutual fund and a share. Traded like a share, managed like more or less like a mutual fund. But since that is dynamically happening, you cannot do it on a typical equity fund and create an ETF. Because then whenever that fund is doing a buy and sell, the price will keep on adjusting and all that challenges. So that is why typically it is done for an index, and they track an index. So you will have different kind of ETFs tracking different type of index in the market. Okay, great. So let me share my screen once again. So far, I hope the pace is okay and you are able to follow me. Right?
Yes, sir.
Yes, Dheeraj.
Okay, great. So let me quickly show you a few things around some of the tools that I was talking about, right? Okay, so yeah, so now I'm back to Zerodha screen. Now, what do you see here? You see certain chart. How do I come here? Let's say, as I was telling you, this is, for example, I want to say Infosys chart. Okay, so Infi is already added here. Let's say Wipro, if I want to change. So I add to my watch list, right? And at the watch list, I click on that symbol. I can see buy, sell, market depth, and this graph kind of thing is the chart. This is one way of reaching there. So I can see this is the Wipro chart. The other way is that I'm on the chart screen. And here I can change, from Wipro, if I want to change it to ICICI Bank. Okay, I just changed this chart and this now changes to ICICI Bank. Okay, so fundamentally, I'll briefly tell you because we will refer to these kind of things. I'll get into more detail in technical analysis section, but let me just take a moment. Now, this is what you call a stock chart. What are you seeing here? You're seeing different, what is called candles here. Okay, they're called candles because like for example, this one where my cursor is right now, it looks like a candle. Some of them don't look like a candle, but most of them look like a candle. So the terminology which is there is called candle, and this whole concept of looking at the price was derived from Japan because the traders there were using this candlestick to trade on the rice as a commodity. And it actually took many years for it to be adopted by the American markets. But that's just a trivia. So the candlestick invented in Japan, now used everywhere, and the most common symbol. A few things. You see on the top of this chart, and this is Zerodha. I'll show you quickly on the trading view also. You see something called 1D. Now, what is this? This is a time frame. So what each of these candles are denoting is the price. How did the price move in that time frame? What you are seeing right now on the screen is how did ICICI Bank price moved during that particular day, in one day. If I'm a short-term trader, right, I'm trading intraday, then it is 1 day is too long a time for me, because I want to know what is happening right now, so that I can exit maybe in 15 minutes, 10 minutes, 1 hour. So looking at the day chart is of very little use to me. So in that case, I'll typically look at a 5-minute chart. Now you see how the price is looking of ICICI Bank from 5 minutes versus 1 day. Let me go back to 1 day. You look at here. 1 day, very peacefully, it is kind of going up. It came down a bit, then it went up, came down a bit, gone up. It is in a range right now. As you can see, last 4 or 5 days, the price is going up. Right. So simple. Green is up, red is down. So on the green day, the price went up from where it opened, and on the red day, the price went down from wherever it opened. Okay. But this is how it looks when you are looking at a daily time frame. As soon as I change it to a 5-minute time frame, as you can see, 2 o'clock on 18th, which was Friday, yesterday, when the market opened, this is where it opened, where my cursor is, right? And then steadily it fell, kept on falling, went up a bit, fell again. After falling, there was a time when it remained in a range, and then towards the end of the market closing, at around 2:15, 2:20, suddenly shot up, right? So it is actually telling you, what is it telling you? If you just look at it on 18th, it actually did nothing much, right? I mean, it opened here, somewhere here, and then it pretty much closed around the same. And how's that looking on the daily chart? You just see where it opened, it went there. So just let me take one quick moment to tell you what does this candle denote, right? Each of the candle is giving you 4 information. And that is what I was showing on the NSE website. It is telling you what is the current market price, what is the open, what is the close, high and low. So when it is during that duration, the current market price will be same as the close, because that is the time you're looking at that chart. But after the session has ended, that would be the close market price. So let me look at a body. So as you can see, there are some wicks. So this is called the candle body and the wick. Wick are those just the thin lines. They are called the wick. And as you can see that some of these candles have wick on both the side, upper and the lower. Like this candle, you look at this particular candle where my cursor is right now. You can see the upper wick and you can see the lower wick, and you see a very small body, very small body. Whereas if you see this particular red candle, there is a very small upper wick, very small lower wick, and the complete body is fairly large. Whereas there are examples, for example, you look at this particular candle on August, early August. There is no lower wick, only small upper wick. What does it mean? So any candle, as I was saying, a green candle, the open is at the lowest point of that particular candle. That's the open. High is the highest point of that candle, right? And if it is a green candle, that open is lower, and then the price closed at the higher point. So the body of the candle shows you the open and the close, and the wicks show you high and the low. Again, I'm repeating. Body shows the open and the close. The wicks show high and the low. So the top part of the wick, the topmost point, that is the highest point. Bottommost is the lowest point. If it is a green candle, then what happened? Price opened lower and closed at higher than the open price. So the open will be the low part of the body, close will be the high part of the body, or for a green candle, because after opening it went up. For a red candle, it is reverse. After opening, it went down. So open will be above the closing. I hope it is clear to everyone. That's all is there in the candlestick. Is that any questions on that, or is very clear to everyone? For information, it is also called OHLC. Open, high, low, close. Open and close are on the candle body, high and low are on the wicks. There could be cases when both are same, so the body will match with the wick, or there won't be any wick, right? For a green candle, open is lower, close is higher of the body. For a red candle, open is higher, close is lower of the body. That's it. Okay. So if that is clear, and I talked about these are the time frames. So you can look at the chart in 15-minute time frame. You can look at the chart in 1 hour time frame. If you look at ICICI Bank in 1 hour time frame, it's pretty much looks like a range bound action, except some period when it violently went up and down, right? So this is where you select the time frame. For a day trading, typically people use 5-minute or 15-minute. For a longer term, if it is a real longer term, you can even look at a weekly chart. And if you can see a weekly chart, it's a kind of an uptrend. But otherwise, daily is a good time frame. If your investment horizon is say 6 months to 1 year, 3 months, you look at a daily chart and make your decision. So this is just the candlestick. Now, if I look at the display, there are different type of candle. Instead of looking at this candle, I can look at the bar. Again, I am not getting into detail of each of them. You can look at a line chart if you are more comfortable with the line chart and see that how the prices are moving. So the challenge in the line chart is they are only talking about the closing price. They don't give you all the 4 information. Whereas the candlestick is giving you open, high, low, close. You are getting 4 information on that. Here, each of these points are the closing price of that particular period. Okay, that's all you're getting. So you can look at that depending on what strategy we will discuss. We may use one or the other, but most of the time you use the normal candlestick chart. Okay, then that is only one thing. All this is telling you is the price information, right? Open, high, low, close. It is not telling you anything else. Now, what if I want to also see what is my volume? Okay, then I go to something called study. I create a volume and I add something called a volume chart. Now, these are the bar charts. This is not price. This is showing me how the volume is moving, right? So you can look at, I will talk more about indicators and stuff like that. So for example, one of the common indicators that is used is relative strength indicator. So I go here and I say relative strength, relatives, or RSI. I think they have the short term. RSI. So RSI is nothing but relative strength indicator. There is a formula for it. I mean, there are many indicators. These indicators are just an aid to you to tell you in a very quick way where the market is, what is happening, and what decision can you take. Otherwise, you have to compute it. So there is a formula behind RSI. Or let's say there is one of the things which is used very, very frequently is moving averages. So you want to check the moving average, and you need to say that for what time frame I want to see the moving average. So if it is shorter, then let's say you can say 20 moving average. As you can see, this price of ICICI Bank on a weekly chart has been, excuse me, since July, trading above the 20 moving average on a weekly chart. Okay, so I will get into more detail in the advanced sessions, and that is why the advanced session and why and which indicator, etc. This was just to illustrate to a point that if someone is saying, chart is showing this, where do I see the chart in Zerodha? How do I set up, add something? And once you have added, you can just save it. You can just save the layout, right? So you can just save preference and you can give it a name. right? Sorry, you can view and you can do a save, right? You enter my first chart. You can just save it. So the next time when I go to say Infi, I will see the same on, I can check the view. Okay, if you have multiple views, multiple indicators. So that is the way you set up the chart. That is the way you make information, make some sense out of the information from the candle. Now the same thing, because this is just give me 1 second. Let me just stop my sharing for a moment. Yeah. So that was Zerodha. One of the tool, which is a charting tool, which is used very, very frequently by many traders, is something called Trading View. For the simple reason that Trading View has lot many features than what the Zerodha chart provides. I mean, Zerodha also has a tie-up with Trading View. So what you see there is Trading View, but there are certain things which you don't get if it is Zerodha chart. So as you become advanced trader, you start using that. There are many inbuilt indicators. For example, so you are able to see my screen now?
No. Yes.
Okay. So now the chart which I'm showing is not from Zerodha. This is from Trading View. I have a subscription. There are free edition also. So a lot of things you get it for free. Once you get into more advanced things, you have to buy a subscription. So as you can see that, the same ICICI Bank chart I can see on the 5-minute, the same candle. Now there are certain indicators, for example, I have put in a lot of indicators, here, 8 different indicators. There's something called Ichimoku cloud. There are many indicators like that, right? Now, one is that I may not get all the indicators in Zerodha. Second thing is there are some proprietary indicators which people have, okay, which they create and they sell it on subscription. Those things you don't get in Zerodha. So once you become an advanced trader, then you start using something like a Trading View or a MetaTrader. Okay, one of these you start using. Okay, so this will come later, but this is just to illustrate that there are tools which traders use. I mean, there are many options here. You can do a replay. Now, if you want to just see, I mean, for example, you want to test yourself. How would I trade based on certain indicator and what is happening, right? I just click on replay. Okay. And then what I do is I start now. If you don't have an idea, you know that it is 2:30. You are simulating that you're trading, right? You had certain idea in mind that this is where I will buy and sell. So once you look at the entire chart, it becomes very easy because everything is 20/20 in hindsight, right? In the rear view mirror. But if you wanted to mimic the actual trading, this is where you can do a replay, bar replay, right? As you can see, this is how the market moves. Yeah, I mean, this is just to give you a sense. I'll talk again more in more advanced sessions, right? So this is one of the tools which I use, obviously, for its flexibility and many features than plain Zerodha chart. But for 99% of the requirement, for majority of you, I think Zerodha chart itself will be sufficient and you don't have to worry about Trading View. Just wanted to show you so that you're aware. And if you graduate to a more advanced level, you can come. So this is one thing. The other thing which I use is, on options, there are a lot of data which is getting generated. I mean, this is all about data. Every second, every tick, lot of information is getting generated in the stock market. And to be a very successful trader, you need to be having an ability to make sense out of that data. So again, Y-Pulse is one of the tools that I have a subscription of. I use, as you can see, this is the live data of Bank Nifty on a 3-minute time interval. They are looking at various parameters, right? Things that impact Bank Nifty. They're also looking at Dow Jones Index, how's it moving? VIX is the volatility. What is happening to the volume? All that information. And finally, they're saying, what is your trend, right? What is the current trend in the 3-minute? So between 327 to 330, as per this algo, the Bank Nifty trend was bearish. But 3 minutes before that, it was extremely bullish. So as you can see, if you are a day trader, how the things change from bullish to bearish to bullish to extremely bullish to bearish, and how nimble and agile you need to be. But if you are an investor, right, why should you bother about all the 3-minute thing? I mean, of course, this one is meant for the trader. So the max they go is 1 hour. But even if you look at 1 hour, little more, you can do some, you don't have to keep on changing your thing. And of course, there are many other, there is open interest analysis, the OI chart, which is, how the number of contracts are moving, the call options and the put options and all those things I'll talk in detail. Don't worry about it. But this is just to show you, this particular tool. One of the tools which I want to quickly show you, is Charting. Okay. Now this is a tool which you can straight away start using. So the OI Pulse and the Trading View probably will come later, but this chart ink and a lot of free stuff is there. What it gives you is a lot of screeners. If you want to screen a stock on certain criteria, then how do you quickly look at it? So let's say that you want to say that, which are the companies where the profit jump is more than 200% in the cash segment. And here it is showing that, your profit is greater than twice of the last year profit, half yearly profit. And you can clearly see that, look, these are the companies who meet that criteria. So one is that there are a lot of scans, which are, I would request you to just play around. It's a free to a large extent. Of course, once you get into the advanced thing, you need to take a subscription. But you can just go to Charting, and there are a few other scanners and the other tools as well. So you come here, you have ready-made scanners available. So for example, if you are a technical trader, you want to see that what are the ones where I can short. And I didn't talk about short, I'll probably cover in some other session. You have this logic, right? This is nothing but some sort of a program which someone has written, which is a canned program, which says that, the yesterday's price was lower than 2 years, 2 days. I mean, you can make sense, right, out of that if you go deeper. I mean, I'm not going to get into each of these things. All I'm saying is that there is a tool like this which exists, and there are some canned scans which are available, clicking on which you can see some very good information which helps you in your own trading, right? You can also create a scan if you want to apply your own logic, right? So you can say, I want to see a stock which is in the 5% of its all-time high. I mean, there would be some ready-made ones for that example, but you can create your own scan. So that's all I wanted to cover today. I hope you are able to follow up to this point. I gave you. See, my purpose is to give you certain pointers. After that, if you are interested, you need to go deeper, right? Yeah, there was a question. Is there a question? Okay, there is some background noise, but I hope. Okay, I will end the recording today. Okay, I will. I hope it was of some use to all of you.
No, Dheeraj, it was very useful. I think thanks a lot for sharing in a very, very, what I will say, very clear manner. It was too good, Dheeraj. It was perfect pace and it was very insightful.
Yeah, I think only towards the end I rushed a bit, but some of those concepts I will cover in the more advanced examples.
Thank you, Dheeraj. This was super helpful.
Great. Thank you so much.
Thank you.
Thank you, Dheeraj.
Have a great weekend. Bye.
You too.
Thanks.
Bye.
Yeah. Thanks. Bye.
Th-
This is So this is, yeah. So that's on. Sorry, I need to get that. I am lost. Just 1 second.
It's in your Zoom app, Dheeraj.
No. Okay.
The last one, you're right. Or if it is full screen, swipe it up.
This is meeting control. Just 1 second. I will let me just stop sharing. Okay. Sorry for that confusion. Okay.